the only order block trading strategy you need to know. In this training today, you are going to learn what are order blocks, why trade order blocks, how to draw the best order blocks, how to trade order blocks, and a step-by-step strategy. And at the very end, I'm going to share with you a secret confluence to help you improve your entries in your trades. Order blocks are supply and demand zones formed from aggressive buying and selling. So you can see over here, we've got aggressive demand, aggressive buying, aggressive supply, aggressive selling coming all the way down. This is the perfect example of showing you how supply and demand works with order blocks. Aggressive supply and demand tells us the market makers are entering the markets and pushing the market in a specific direction. This is the footprint left behind. It reveals to us displacement. Displacement is when you see these big fat candles which show you that massive orders are being executed. This means there's a lot of momentum, there's a lot of volume pushing the price either up or down. These momentum candles show you that smart money has entered into the market. You don't want to see small candles. Those are the small buyers and sellers. This means there's no momentum and there's no volume. Why trade order blocks? Because you want to trade side by side with the big players in the market who trade these large position sizes. You want to leverage off of their trades. The best way to know when they're entering the market is to pay attention to the supply and demand. This is when you see that aggressive buying and selling. We are all small fish retail traders, and we don't have the money to push the market. The market makers trade with multi-million dollars, even billions of dollars. Here's an example. As you can see over here, we get massive displacement. Can you see these big displacement candles? They leave behind an order block. We mark out that zone. And that's precisely the area when price comes back into this zone where we see big price movement and reactions off of that zone. This is where the smart money are buying. This is where you want to enter into the market. It's literally free money. You want to ride the wave with the smart money. The worst idea you could have is to trade against the smart money. You will always end up on the wrong side if you do it this way. How do you spot these order blocks? You want to see at least 2 to 3 momentum candles in a row. If you look at this example, you can see massive momentum candle, massive momentum candle, massive momentum candle. This is showing you that smart money is entering the market. Just remember, you don't look for small candles. You always want to trace back the move to where it started. This is the exact point here before we got this aggressive buying, this aggressive demand in the market. Can you see all these big momentum candles? We got displacement, we got volume. This is the sign we're looking for. And when price comes back into that zone, look, we get aggressive supply, aggressive selling all the way into the zone, and then we get a massive reaction off of this zone. So this is how it works. In a long trade idea, when you get this aggressive buying or this aggressive demand in the market, it often leaves behind an order block. And an order block is an indecision candle. Can you see over here? This is an indecision candle. It's when you get a small candle with even side wicks. Sometimes it's not going to be 100% perfect, but this is how it looks. It's when you get contraction happening before you get this explosive move. You mark out the low and the high of this indecision candle, and this becomes the order block that you draw out. Then what you do is you drag that zone all the way across the chart, and this becomes the area where you wait for price to come back into that zone, and then you look for a reaction off of that demand zone. These have very high probabilities of reacting because this is precisely the area where large transactions were previously placed. For a short trade idea, going to be the opposite. Can you see over here, we got this aggressive selling or this aggressive supply in the markets, and it leaves behind an order block. Look at this indecision candle, small little doji, equal sides, contraction candle. We mark out the low and the high of this candle, and that becomes our order block zone. We drag out that zone and we wait for price to come back into this zone. When price comes back into this zone, this is a high probability trade area. and then we observe how price reacts to this level. This becomes an excellent place to enter your short positions. There is also a consolidation method. So once again, you see this explosive movement, you see this explosive aggressive buying in the market. It leaves behind consolidation zone or contraction zones. When we get this contraction happening, this is a key sign that something is building up in the market. And oftentimes we get these explosive moves after contraction has occurred. And we draw out this box, we extend it across, wait for price to come into the zone. You can see over here, price tapped into the zone and we had massive reactions. Look at this big wick. This is showing us that many positions are being triggered. Another method of order blocks is using the wicks. The wicks show us when price is rejecting a zone, whether it's a supply wick or demand wick. These are liquidity zones or liquidity lines. These are precisely the areas where we have resting liquidity, and these are also a form of order block. So as you can see over here, all we've done is we've marked a zone over the wicks and we've dragged it across. Every time price is tapped into that level, we get a reaction. Tapped into that level, get a reaction. Sometimes it's not going to be 100% accurate, as you can see in this example, but as soon as price reclaims on top of that level, that can become a place to enter. These wick order blocks are excellent probability zones. And for our supply example, you can see over here, look at this big wick. We mark out the zone on that wick, we stretch it across, and as price taps into that zone, we get a reaction, and this becomes a place where we look for our entry. As price reclaims that zone or comes back under, we can enter our position. But this is just showing you how price travels from liquidity to liquidity. And now for the order block trading strategy. It's a super simple formula. Let's dive right into it. So you can see you've got step number 1 over here. We want to identify 3 momentum candles. You can see massive candle, massive candle, massive candle. Once we see these momentum candles, this is the first sign we're looking for displacement. Once we get displacement, then we mark out the previous bearish candle before the bullish move, or we're going to mark out an indecision candle. As you can see over here, indecision candles normally have big wicks and small bodies, or big wicks and medium-sized bodies. And then we mark out the high and the low of that indecision candle. This becomes our order block zone. Then step number 3, we drag that zone across and we wait for price to tap into that zone. When it taps into that zone, we pay attention to how price reacts at that level. And then number 4, we wait for confirmation before we enter. So as price comes and taps into that zone, we look for rejections, and you can see the big wick is showing how price is rejecting that level, does not want to push past that level because massive orders are being triggered. This shows us that there's buying pressure happening in this location and that the buyers are stepping into the market. Then what you want to do is you want to jump into a lower time frame. Price taps into that level, and then we just wait to take an entry on the next engulfing candle. And we set our stop loss under the low of the order block. And then all you do is you rinse and repeat with this strategy. So as you can see over here, we get momentum candles, we get displacement. That lets us know where the order block is located. We mark out the order block zone. We wait for price to come back in that zone. That is the point of interest level where we look to take an entry. Our target is always going to be the previous supply zone or supply order block. Or we can also target the supply liquidity lines located over here. Can you see this target? This becomes our target zone. And now I want to share with you a secret confluence to layer on top of this trading to make it even more effective. The secret confluence is using Fibonacci. It's always good to stack your confluences on top of each other to give you more confirmation and more confidence. In this example, we're going to add Fibonacci. All we want to do is we want to drag our fib from the low of the range to the high of the range. You see, we've got this green dot and this red dot. And then we pull our Fibonacci up. In this fib, I've marked out specific levels. We've got the 65%, 79, and 88%. When price gets into the 65 to 88% level, that is a discount zone. This is the zone where the market makers are looking to enter their long positions. Because think about it, if you were a market maker, you're looking to enter where you're going to get the best price for your entry. So for long positions, we're always looking for these discount zones. For short positions, we're always looking for premium zones. Here's another example. If you look at this example, we get these massive momentum candles. We mark out our order blocks. Price comes back into our discount zones. Remember, our discount zone is 65% to 88%. As it taps into those levels, you can see these rejections into those zones. This is showing us that price does not want to go further down and it keeps reacting at a discount zone. After watching this video, backtest the strategy, forward test the strategy, practice marking out your zones, practice pulling your Fibonacci. Now I'm going to jump onto the chart and show you exactly how I did this. So here we are on the charts. I'm looking at a cryptocurrency coin called Popcat. Now, first of all, this strategy works whether you're trading crypto, forex, indices, stocks. It doesn't matter what you're trading. If it has a chart, this strategy will work. And you can see over here, if I'm looking at the chart, guys, I'm looking for where there's momentum. And you can see, look, there's momentum over here. There's momentum over there. There's momentum over here. So the first thing we're doing is we want to find the footprint of the market makers. So we're looking for these massive displacement candles. I'll just focus on the first one over here. So you can see we got this displacement candle, and all you want to do is you want to mark out the order block before the displacement occurred. Can you see this over here? So usually an order block is the previous down candle before the up move, or an indecision candle. And depending on the time frame you're looking at it, it will also change the candle. I'm on a very high time frame, and I recommend doing this on a higher time frame, whether it's a 12-hour, an 8-hour, a 4-hour, depending on what trading style and time frame you like to trade on. For this example, I'm using a 12-hour. So you can see we got this massive displacement. I marked out the zone. Price came back into the zone perfectly, guys. I mean, look at that. Perfectly tapped into that zone and reacted off of that zone. Then what you can also do is you can pull a Fibonacci from the top to the bottom. And there you go. You see, as price tapped into the 88%, this becomes our discount zone that increases our probabilities. Once price taps into our demand zone, we can drop to a lower time frame to look for a more precise entry. I drop now to a 15-minute time frame, which is my entry time frame. And let me zoom into this exact position. You can see over here, this is the precise location where price is tapping into this demand zone. So now there's various different ways we can take this entry. One of the best and easiest ways, we wait for an engulfing candle. Can you see this candle over here? This is an engulfing candle, engulfs the candle before it. We can take our entry on that engulfing candle. Our stop loss comes under the low, and then we can target the liquidity line at the top. This would be our liquidity line over here. And that is our perfect trade, guys. Price taps into the zone. Once it taps into the zone, we wait for an engulfing candle. We enter on the engulfing candle. We set the stop loss below the swing low. We target the high of the range or the liquidity line. And as you can see, this would have been an absolutely perfect trade. If you want to learn more about trading price action, we have a Discord group where we teach you everything you need to know to become a professional trader. We have some of the best price action trading indicators with proven strategies and mentorship to help you become a successful trader. So click on the link below, check out what we have to offer, and we'll see you inside the group. Happy trading.